If your business feels tight on cash right now, you should be able to apply for a loan or a line of credit and get something suitable. A lot of strong business owners are feeling pressured, not because their ideas or underlying business is bad, but because the rules around getting and securing capital for your business has changed. What surprises most people is this: loan outcomes often are decided long before the application is even submitted now. Not because a bank dislikes you, but because your financial profile is already sending signals that you may not even realize. In this video, I'm gonna walk you through a simple 90-day preparation window and actionable steps on what to do during that window. It's the window that lenders care most about, and it's where many approvals are won or lost. If you want a realistic path to funding in 2026, this is where it starts. The 2026 capital paradox. We're in a strange moment for business funding. More owners are looking for capital, but lenders are being more selective about how they deploy it. Interest rates are lower, risk standards are tighter, and underwriting has become more data-driven than ever. That doesn't mean funding is unavailable. There's more capital out there than ever. It means that preparation matters more than effort. Most rejections aren't ambition or work ethic. They're about files that don't meet today's rules and standards for underwriting. Once you understand that, the process becomes more manageable. Here's how modern underwriting works. When you apply for a loan or a line of credit today, in these day and ages, an automated system usually reviews your information first. These AI-based systems scan your banking activity, accounting data, and tax records quickly to identify any potential risk patterns. They're not judging your vision or your idea or your underlying business model. They're evaluating consistency and control in your cash flow. This is why timing also matters. What your business looks like during the 90 days before you apply often carries more weight than what you say in the application itself. So let's walk through what those 90 days should actually look like. Your first 30 days. The first month is about clarity and separation. One of the biggest red flags lenders see is when personal and business finances are mixed together. It makes it hard to understand what the business is really doing. So make sure you get yourself a good accountant that separates those and helps advise you properly. If you don't already have a dedicated business checking account, that's your first step. This is the time to fix that. From this point forward, business activity stays business only in your business checking account. Next, pull your credit reports from Experian, Equifax, and Dun & Bradstreet. You could use a site called Bureau Insights. Look for errors or outdated information. Corrections can take time, which is why we have this step happening early. You also want to make sure your business is in good standing with the Secretary of State. Are your licenses current? Are your filings up to date? So most of the time, all it takes is you logging into the Secretary of State website, paying a small fee, and then they reactivate your business if it's not already. Then finally, you want to get clear on your purpose. Don't apply for capital with a vague plan. You want to have a clear use of funds and return on investment. Lenders want to know how much you need and what it will be used for. Specific goals signal leadership and planning. These are things that are green flags for underwriters. Days 30 to 60. This second month, we're gonna focus on your financial strength. This is where you wanna start paying close attention to your cash flow. Make sure you have an accountant that's gonna help you with your previous tax returns and current profit and loss statements. You and your accountant need to use a metric called the debt service coverage ratio when preparing, or DSCR. In simple terms, you're gonna wanna see that your business generates more cash than it needs to cover its obligations. A healthy buffer is gonna show them resilience. It's gonna tell lenders that you can handle slower months or potentially unexpected expenses. This is also the time that you wanna gather your tax returns from the last 2 or 3 years if you're going for something conventional. Lenders look for consistency, and big swings in net profitability are going to raise questions. So review your profit and loss statement carefully. Cut expenses that aren't helping the business grow. Renegotiate wherever possible, especially with vendors and suppliers. Every improvement you make here strengthens how your business reads on paper. Final 30 days. The last month before you apply is all about checking to make sure you have all your ducks in a row. Lenders are gonna look very closely at your bank statements. They're gonna look closely at your credit report. They're gonna look closely at your balances, at your profitability, and you should know all of that. You should be prepared. Try and avoid overdrafts completely throughout this year. Try and make sure that your profitability is increasing on a year-over-year basis. Don't stack short-term financing vehicles. Maybe 1 or 2 are perfectly fine in order to accelerate your growth, but having multiple is a problem in the eyes of underwriters, especially if they're listed on your balance sheet and your debt schedule. I know it's easier said than done. Predictively raising your revenue on a month-over-month basis is something that every single business owner wish they could do. I wish that I can raise my revenue every single month, and that's our goal. So if you can stick to your goal and at least do your best to keep a cushion in the bank and a high average daily balance of at least 10% of whatever it is that you're making every single month, you should be okay. Look back at your entire year. Look back at your last 12 months of business bank statements, at your most recent tax return, and at your credit report. And basically, you want to look at it as if you were a lender or an underwriter. Once you start to think like them, it becomes a lot more predictable. Remember, consistent deposits, clean spending, and calm activity matter more than your growth. Choosing the right type of capital is the most important stage here. Not all funding fits every business. There are certain lenders that prefer certain industries. There are certain programs that are better for certain situations, and some situations call for a term loan with predictable payments. Others are better served by a line of credit that flexes with your cash flow. There are also newer programs in industry-specific options available in 2026, particularly for manufacturing and heavy revenue-generating businesses. The key is alignment. A lender who understands your industry and cash cycle is often a better partner for your growth and to write your note than the biggest bank in the room. By this point, you've done the hard work. You've gone through the 0 to 90 days. You've cleaned up your foundation, strengthened your numbers, and stabilized your day-to-day activity. And you've gone over the last year and you've looked at your file like a lender. That's how you move from reacting to planning. Below this video is a link to book a call with my team. We'll review your business through the same lens lenders use and show you exactly how you stand on this 90-day path. You'll know whether you're ready now, need to clean up a few things, or need more time. And you'll know what to do next. You'll stop playing guessing games. We're not gonna sell you anything. We just wanna help you. We want a partnership. Funding doesn't come from rushing. It comes from preparation, especially the good funding. To see an expanded version of how lenders view your bank statements, watch this video. It's a step-by-step process of how lenders and underwriters go through them. If you have any questions, please feel free to reach out to me in the description and the comments, or send us an email. And remember, the best time to start preparation for your business funding is now. It's better to be proactive than reactive. It could save you thousands, tens of thousands, or hundreds of thousands.